optionchampion.com. All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to a very special edition of Tricks of the Trade, the basics of options. We're going to cover what options are, the types of options, and how those types of options are used. This is strictly an introduction to options, not about shorting or advanced strategies like spreads. Those will be covered in future videos. So what exactly is an option? An option is a contract that controls the buying or selling of shares of an underlying stock at a set price called the strike price on or before a future date called the expiration date. Each option contract controls 100 shares of the underlying stock. And just like stocks, options can be bought or sold and are priced at a bid to buy and an offer to sell. But in the world of options, the price is called a premium. Unlike stocks, options are time-valued instruments. They depreciate as time passes and the option gets closer to its expiration date. In every options trade, there is a buyer and a seller. The buyer of an option is called the holder of an option, and the seller is called the writer of an option. This is similar to the insurance business, where there's the writer of an insurance policy and the holder of an insurance policy. In fact, options are like insurance on a stock. They provide protection in the event of a significant change in the price of the underlying stock. I'll expand on that a little bit more in a moment. Options are derivative instruments, meaning they are attached to an underlying stock. And because they assume the future value of a stock, they are speculative instruments. An option's performance is dependent upon the underlying stock's performance relative to the type of option. There are two types of options, calls and puts. Call options control the buying of shares of the underlying stock, while put options control the selling of shares of the underlying stock. Each set of options, calls and puts, are listed on a matrix called an option chain, with calls on the left, puts on the right, and the strike prices in the middle. The expiration dates may appear along the top, as shown here, or as expandable section headers on the option chain, depending on the financial data website or trading platform. A call option is purchased by an investor who believes that the underlying stock price may rise in the future, whereas a put option is purchased by an investor who believes the underlying stock price may fall in the future. Let's look at an example of a call option. XYZ stock is priced at $50 per share. You believe the stock will go up over the next 6 months and you want to buy 100 shares, but you're not ready to buy the shares yet. This can be for a variety of reasons. Maybe you're unable to commit capital at that moment, as 100 shares at $50 per share would cost $5,000. Or you're afraid of the stock going down, since you would lose $100 for every $1 drop in the stock price. So you go into the options market and look at the call options that expire 6 months into the future. Remember that your belief is that the stock will go up over the next 6 months, so you're looking at the 6-month options. You find a call option with a strike of $50 per share, where the stock is currently priced today. The $50 call option is priced at a premium of $5.25. As mentioned earlier, an option controls 100 shares of stock, so buying this call option at a $5.25 premium would cost you $525. Instead of risking $5,000 buying 100 shares of the stock at $50 per share, you're only risking $525 on the call option. If over the next 6 months XYZ rises above the $50 strike of the call option, you can exercise the option and buy the stock for $50 per share. Keep in mind that you also paid a premium of $5.25 for the right to own the stock at $50 per share. So your break even, or total cost, is $55.25 per share. That's the strike price plus the premium paid for buying the option. If XYZ fails to rise above the $50 strike of your call option, you would either allow the option to expire worthless and lose the $525 that you paid to buy the option, or you could cut your loss by selling the option back to the market and receive whatever premium is left in the option. Now, you don't have to buy a call option just to secure a purchase price of the underlying stock. You can buy a call option to simply make a bet that the underlying stock price will rise above the strike price by the option's expiration date. If the stock price rises and your call option's premium rises as well, you can sell your call option back to the market for a profit, as long as the market's premium is above the premium that you paid when you bought the call option. Now let's flip that scenario and look at an example of a put option. Let's say you already own 100 shares of XYZ stock at $50 per share. The stock has been on a good run and is currently trading at $70 per share, up $20 per share from your purchase price. So your 100 shares have earned $2,000 at this point. But the markets are beginning to look a little shaky. You're worried that there could be a big sell-off looming ahead and your XYZ stock might suffer a significant decline. So you go into the options market and look at the put options that expire 6 months into the future. Not knowing when a sell-off might actually occur, within a week or a month or even a few months down the road, the 6-month options would buy you some time. With the stock currently trading at $70, you find a put option with a strike price of $70, and it's priced at a premium of $5.25, using the same example from earlier just for simplicity's sake. Remember that option contracts represent 100 shares of stock, so buying this put option at a $5.25 premium would cost you $525. If over the next 6 months XYZ falls below the $70 strike of the put option, you can exercise the option and sell the stock at $70 per share. But remember that you also paid a premium of $5.25 for the right to sell the stock at $70 per share. So your break even, or total proceeds from the sale, would be $64.75. That's the strike price minus the premium paid for the option. If XYZ fails to fall below the $70 strike of your put option, you would either allow the option to expire worthless and lose the $525 that you paid to buy the option, or you could cut your loss by selling the option back to the market and receive whatever premium is left in the option, just like in the example with the call option. And you don't have to buy a put option just to lock in a sale price of your stock. You can buy a put option to make a bet that the underlying stock price will fall below the strike price by the option's expiration date. If the stock price declines and your put option premium rises, you can sell your put option back to the market for a profit, as long as the market's premium is above the premium that you paid when you bought the put option. In each of these scenarios, the $5.25 premium was used as a very basic example. The actual option premium would depend on the activity in the underlying stock, as well as the activity in the stock's options. And that's the basics of options. See you next week when we dive into the building blocks of trade analysis and setups. I'm Rick Adams. Thank you very much for watching. See you next time.